Hey, good morning, guys. This is Cousin Marva Eisen from Timeless Dollar. And if you are looking at this video for the first time, Timeless Dollar is a place where I can show you how you can utilize the S&P Emini's futures to generate your own income, be your own boss, and be financially secure and independent for life. Trading futures involves substantial risk, and I'm sure most of you know that. But there is a way to trade futures, if you're not greedy, that you can make a significant amount of money. How significant? Enough to support yourself, replace your job, and live comfortably for the rest of your life. Let's go. This is the chart of the S&P E-mini futures contract. This is a one-day chart, and we are right here at, this was June 10th, yesterday. And if we look back toward the beginning of June, we see that the market has been in a steady rise up. Today, futures are indicating a jump of about 25 to 30 points over the close of yesterday, over where the S&P closed yesterday. So the market is just about to open. It's 9:30. The market is just opening. I'm going to switch to a 3-minute chart. And of course, we could jump in here. We could jump in here and take a position, but I'd rather not be hasty. And especially if you're just watching, let's just watch the market and see where the place is to trade. I trade in a very simple way. I don't load my chart up with indicators. I use only one indicator, stochastics, together with the candlestick patterns. Candlestick patterns are an easy way to visually see which way the market is going and how traders are reacting. Today we see as the market opened, this is the opening candle. The market opened at 29.07, right now trading at 29.09, vacillating back and forth. Stochastics is the only indicator that really is a forward-looking indicator of where the market may be going. And I use that in conjunction with the candlestick patterns to see where the market is going, and I use those patterns to take a trade either long or short. We can get a sense of what other traders are thinking by looking at the candlesticks. The market opened at 29.07, and we could see in fairly short order, it's jumped up 3 points to 29.10. And why do I say fairly short order? Because we see this candle. This is a 3-minute candle. These are all 3-minute candles, and we see the movement over 3-minute periods. The green candle indicates the price started down here and ended here during that 3-minute period. A red candle means that the price started at the top and headed down for that 3-minute period. So we can see which way the market sentiment was at that point in time. So we can see how traders are thinking. Right now, the traders in 3 minutes have taken it up 3 points. Stochastics, which I said is a forward-looking indicator, is showing an overbought condition. Now, typically, if you can look at the stochastics, you see it gyrates between limits, up and down. And the gyrations of the stochastics, together with the candlestick signals, and you don't know anything about candlestick signals, but there are recognizable patterns. Those patterns, together with the signal that the stochastics is giving us, is an indication of where we might put on a trade that will be profitable, that will go in our favor. We can trade market going up, market going down. And that's a wonderful thing in futures. Right now, the indicator is showing us that prices are oversold. In other words, buyers are very exuberant. There's a lot of buying activity. But right now, there's some hesitation because we see prices have basically plateaued here at 29.10. And now the bulls, the people who drove the prices up in the first 3-minute period, now they're getting a little unsure of themselves. So with the stochastics at the high, now they're thinking, maybe we bought something and paid more than we should. So they're not so sure, and they're not jumping in so fast now. So now the bears are looking at this and saying, wow, we can get a real deal if we short the market. Now the bulls are getting a little worried, and the bears are looking at this, and they see the stochastics here, and this would be a place to jump in and maybe take a position negative to the market and see, there we go, there the bears are forcing prices down. The stochastics are showing that the prices were overbought. This could have been an area to take a position to the negative side and ride it down for a bit and make some money that way. You can make money going up, you can make money going down. That's the wonderful thing about the market. You don't have to wait for a period of rising prices in order to make money. You can make money if you think prices are going down. So here we are. Prices are down to where they started the day. It's only 9:37. We're 7 minutes into the day. And wow, look at this. The bears are pretty sure that these prices are overbought. And they are driving the prices down. Now, if you took this trade and you took it at 29.11 and wrote it down to 29.06, you could have picked up 5 points. Now, 5 points in the S&P E-mini market, each point is $50. So even trading one contract, you would have made $250, now $300 if you just bought up here and sold down here. Of course, when the prices were up here, you had no way of knowing that they were going to go down here, except there was a signal. There was a signal. What was that? I pointed it out to you. The bulls drove the prices up. Exuberance. This is what's called irrational exuberance. Man, look at those prices dropping now. And then the second 3 minutes, prices started to, they went up, but not as much. There was uncertainty on the part of the bulls. And the bears then jumped in. They said, wow, there's a buying opportunity here because there's no more buyers up here. So the bears jumped in, drove the bulls down. And if these guys who bought over here, now prices are down here and they're underwater. I told you, there's no reason to jump in. Sure, do you jump in early in the day when you see a momentum move like this? You could, but I'm here to show you how to trade. This is a normal reaction to an overbought market, and it was discernible by the difference between this candle, the first one and the second one, and also the position of the stochastics. I told you this before this candle even came on the scene, right? Okay. So that's how you trade the market.